Jamie Dimon admits that if he'd read the Wall Street Journal a little bit more closely, he might have avoided an embarrassing $2 billion loss. Good morning. I'm Rolf Winkler. Welcome to the News Hub. Joined today by my Heard on the Street colleague, David Reilly.
Good morning, Rolf.
David, here's how we reported it last month.
This index that he is focusing on is an index that was launched in 2007 and is now effectively an old index that was very liquid. It's been one of the oldest indexes that's still sort of liquid since the crisis, but it's not traded nearly as much as some of the newer indexes. So it might be difficult for him to get out of some of these positions potentially. So they've got to be very careful how they start to unwind some of these trades.
And indeed, it was difficult to get out of some of these positions, and it led to, of course, an embarrassing $2 billion loss.
Pretty rare for J.P. Morgan.
Right, and here we have some sound of Jamie Dimon last night on an analyst call discussing the loss.
The portfolio still has a lot of risk and volatility going forward, so how are we going to manage that? So, number one, we're going to manage it to maximize economic value for shareholders. What does that mean? It means we're not going to do something stupid. We're willing to hold as long as necessary inventory, and we're willing to bear volatility. Therefore, the volatility for the rest of this quarter and next quarter or so will be high. It could cost us as much as $1 billion or more.
This was actually reported about a month ago in our paper. Right. There was a London whale. Tell us a little bit about what happened.
What was reported a month ago in our paper was that there was a unit within J.P. Morgan called the Chief Investment Office. And what this unit does is it invests a lot of the bank's money. And people say, well, why is the bank investing money? And what you have to keep in mind is that a bank like J.P. Morgan, it has about $1.1 trillion in deposits. It maybe only has about loans of $700 billion. So what does it do with that other $400 billion? It invests in securities, and a lot of that runs through this Chief Investment Office. Now, as part of this, they're not just, say, buying a T-bill and rolling that over endlessly, although a lot of people maybe in the wake of this say they should be doing that. So what they're doing is they have a lot of hedging going on around this, and at some point in recent months, the bank's hedging strategy and a part of this portfolio got so big that they sort of became the market for the type of product they were using, and they became very exposed. And that's what our story was about. So now you flash forward to today, and maybe it's just the way they constructed that position, or it seems also how they were trying to counter that hedge or unwind it.
The hedge funds were literally betting against them, right?
Hedge funds were betting against them.
Fast money has smelt blood was the quote in our paper about we see the London whale. He's got. Basically, he's sold a lot of protection on some credit default swaps, insurance-like products,
right.
And we're going to take the other side of that because we think he's in a dangerous position.
Right, and then so whatever the back and forth and the maneuvering over the past 6 weeks of the second quarter, that led to a $2 billion trading loss at J.P. Morgan. And that's what yesterday afternoon around 4:30, J.P. Morgan filed its first quarter, what we call the 10Q, which is its quarterly SEC filing, and they disclosed that loss in the Q, and then they followed up with this hasty conference call with the markets at 5 o'clock yesterday. Yeah, I mean, it was funny. We were sitting on the desk yesterday, and I think you saw my reaction where suddenly I'm getting emails, everyone's saying, what's going on? What's going on?
Yeah.
And it just really took the markets by surprise.
It did, and we've got, let's jump in here. We've got a quick, we got a slide here showing how I think bank stocks reacted pretty negatively yesterday.
They just went off the cliff.
Everything went down.
I mean, J.P. Morgan was down yesterday afternoon around 6%. This morning it's down about 8% pre-market. There we've got on the screen, okay, 6.5%. You don't see J.P. Morgan moving 6% down in a day. That's something people think happens to Citigroup or Bank of America.
And that's a big move, despite the fact that the $2 billion loss, it's actually not that much money for a bank of this size.
Let's put this in one perspective. In terms of the financial hit to the bank, this is manageable. Of course, if it balloons out to a multiple of that, then you're talking a different issue. But right now, this is a bank, last quarter, they had net income for the quarter of $5.4 billion. Regularly, J.P. Morgan can be expected to earn about $20 billion in a year. And this $2 billion, they're not, as Jamie was talking about, Jamie Dimon, the CEO of J.P. Morgan, was talking on the call yesterday, they're not just sitting there and watching this going against them. They're trying to trade their way out of it and deal with it. The loss might be greater, might be smaller.
That's a key point, is they're still there. There was a really interesting quote on the call when he said, we've got staying power and we're willing to use it.
Right.
In other words, they're still in some of these trades, and they feel like they've got the balance sheet, the power to ride it out, and maybe prices will move back in their favor, and then they'll recognize more.
In some ways, if you do have that staying power, what you want to do is when everyone's piling on you and smelling blood in the water, you don't want to be forced to have your position. But I was just chatting with someone in the markets a little while ago who pointed out to me, said, and this is very trader sort of talk, said your first loss is usually your best loss, meaning that's the one you can get out of quickest. So it's by no means, this could still go against them. They could be stuck in here. It's an open question. But at the end of the day, this isn't going to bring down the bank. It's not like this is something they can't handle. Beyond just the financial impact, the bigger question is how this plays into the too big to fail debate.
Does it play into that?
Oh, completely. I mean, you just look, within an hour of this news coming out, or the conference call ended, one of the things popped in my inbox was, here's a statement from Senator Levin of Michigan, who was an author of the language in Dodd-Frank in terms that put in place the Volcker rule, and saying, hey, here's an example of what can go wrong. Jamie Dimon was saying on the call yesterday, and JP Morgan has said, look, we have to be able to invest this money. And that is true. A bank, if they can't make a loan, they have to invest.
But why not agencies or something like that, right?
But the question becomes, at what point does an investment or a trade that the bank is doing actually become more than we're just trying to invest that money and we're really taking directional bets on the market, more like a hedge fund does? That's the crux of the Volcker Rule, what makes it so difficult, because it's so tough to tell where that line is.
We want to throw a shout out to the News Hub GMT that was on top of this, and the London Whale. David, tell us a little bit. So we know a little bit about who this person was. He was a French banker, and he commutes into London. Really one guy at a desk with, I guess, a couple junior analysts who was putting on a lot of these trades?
There was one guy at the desk, but keep in mind, it's not like they just got a guy sitting in London, and it's that he is part of an office. That office, the chief investment office, is headed by a woman named Ina Drew, who is a very important executive within the bank and has been there for a long time. This unit's been there, and there have been reports after our initial story that Jamie Dimon was very involved with this unit, maybe in some cases even saying, hey, here's a good investment to be making. So the person, it seems, Bruno Ixel, putting on the trades, that was for one specific part of the portfolio. But it's not like, let's not pretend that Jamie Dimon turned and said to some guy in London, here's $400 billion, call me when you're done with it.